if we had, Mona, if you had to say bullish, bearish, or kind of a little bit of a mixture, depends on the stock. Where are you right now, Mona?
Yeah, probably that third option. Look, one thing to keep in mind, Joe, is that we're coming off the back of 3 years of very strong S&P gains, over 20% on average for the last 3 years. So yes, we've come into 2022 with many challenges, to growth, inflation, the Fed, and we're still down about 6% on the S&P. So the resilience has been pretty notable. Keep in mind, generally, we think in a higher inflation environment, equities can outpace the rate of inflation. Within equities, we think there are parts of the market that can pass along costs. If you think about those more defensive parts of the market, healthcare, staples, even utilities, which we've seen hold up nicely this year, those parts we think continue to fare well, especially as we get later cycle. The value rotation we still think has another leg here, especially as we get to spring and summer months and we start to get a little bit more reopening demand. So that's a part of the market we continue to favor near term. But more broadly, we think with earnings growth, probably mid-single digits this year and some valuation compression, we're looking at a flattish year, but after a pretty strong run.
It's Sarah, same question?
I think that it's not going to be a blockbuster year like the year we had, but after the last couple of years, who's not excited for things to get a little bit boring? I don't think we're going to see things fall off a cliff for the most part. Maybe some of the stay-at-home trades, some of the Netflixes where, I don't know about you, but I do not plan to spend the summer sitting on my couch watching TV. I think that we will see some companies that really, really, really are going to have a hard time in this hopefully boring new world.
The biggest worry you have at this point, Sarah, is inflation or the Fed's reaction to inflation or the possibility of a growth slowdown. What is it? All those? All the above?
I mean, in my world right now, the rising rates are driving massive write-downs and losses in later stage private tech companies, right? You see companies like Instacart where they just cut 40% off of their valuation voluntarily, not even to raise more money, but to help with employee retention. And, they were talking about a big IPO this year. That's not happening this year. I don't know if that's going to happen next year or ever. These are big, big problems in the private tech markets.